I'm joined right now by Andy Rice, Senior Vice President of the Jordan Company. Andy, thank you so much for joining us.
Thank you, Claudia. Glad to be here.
Talk to us a little bit about the Jordan Company.
We are a middle market private equity firm. We have about $8 billion of assets under management, and we primarily invest in U.S. companies that are leaders in their niches. And I head up our international efforts to help our companies expand globally. And for the last 10 years or so, we've been focusing primarily on China and Asia.
Now, as you mentioned, a great majority of your investments have been in China, but you're also looking to expand outside of China. Talk to us a little bit about the changing landscape and why that's happening.
Well, we made a decision, as I mentioned, 10 years ago. Most of our investments are in the U.S., but for international, we were in Russia, Brazil, India, and for a variety of reasons, we decided, China's the fastest growing, most stable market, so we focused on China, and we were one of the first U.S. private equity firms to really focus on China with an operations support group, and not a lot of competition. There was a lot of opportunities to quickly go in there, build factories, develop business, low-cost manufacturing. Now, it's a lot harder to do low-cost manufacturing. Labor costs increase, they double about every 5 years. There's a lot more competition. There's a lot of both foreign private equity firms, a lot of Fortune 500 companies that are looking to buy companies that private equity firms are also looking at, so those are strategic deals. And then there's a growing, dramatically growing group of Chinese domestic private equity firms, and they tend to way overpay. We're looking at buying a business where we think it's worth 8 or 9 times last year's EBITDA earnings, and these companies are bidding 12 or 13 times next year's forecasted earnings. And that only makes sense if you can go public, but very few end up going public, but that's the dynamics. And so it's just harder to find good companies, and then even if you like one, to buy it at a reasonable valuation.
From a consumer point of view, in China, we were talking earlier about how in this country you order something, a piece of technology, and you get it. It's a different situation in China, although that's changing as well.
Right. There's been a lot of advances in both infrastructure development and technology where, for instance, what you're referring to is there's a lot of great U.S. companies that have a niche where they provide a product or a part that they can deliver anywhere in the U.S. by tomorrow. UPS, comes in, picks it up, whatever. That was not possible in China until just the last 1 or 2 years. So companies that provided next day service, they'd have to have their own fleet of trucks and drivers to deliver. And that's very expensive to own trucks and have people. Now, with the expanded highway network, airports, etc., there are companies, logistics firms like UPS, that now have services where you can order something from Shanghai and deliver it 500 miles away, and the customer gets it the next day. That is dramatically changing the way companies distribute products, and so the investment opportunity exists for companies to buy companies that are leaders in several cities, combine them, consolidate them, bring in management that can operate a bigger group, and there's tremendous synergies, economies of scale, etc. And I think there will be a huge wave of those opportunities in the next 10 years. The challenge is they take a long time to implement, and a lot of private equity firms have a shorter term investment horizon. So that's the challenge, is how do you find those opportunities and execute in a 4 to 5 year time frame, when in the past those sort of opportunities would take 6 to 8 years to really create value.
Okay, now looking outside of China, looking at Southeast Asia, what are the opportunities that you see there?
Well, because of the competition in China, we've started to look at Asia outside of China, and in Southeast Asia it's very exciting because they've been working for 8 years to create a common market of Southeast Asia. It's called the ASEAN Economic Community. It's modeled after the EC, except they have no plans to have a common currency. But at the end of this year, they're getting rid of most tariffs between those 10 countries. They're going to start allowing skilled workers to move freely within the countries. That's not going to happen right away, but the plans are free movement of goods, capital, services, etc. You're already seeing, for instance, in Vietnam, I was there in December, thousands of Chinese companies are building factories in Vietnam to serve customers in Southeast Asia because they have a 5 or 10% tariff, and right now everybody's got a tariff. When those tariffs go away, they're not going to be able to compete unless they have manufacturing somewhere within the ASEAN region. And so we're going to see more Fortune 500 companies that are going to be setting up manufacturing in Southeast Asia, and then they're going to want their smaller mid-sized companies to follow them, and that's where the private equity firms come in, because we own a lot of mid-sized companies, and then we can help them make those investment decisions to follow.
Speaking generally, we know that the digital landscape globally has changed just incredibly and continues to do so. How has that affected M&A globally?
It's interesting. Deal flow, you get a lot more deal flow that way, but we find our best deals are where you have a relationship with someone, they know the owner of the business, they discreetly talk to us about it, and those end up being the best deals. And those are not, if you're the owner of a company, you don't want the industry thinking you're going to sell, you don't want your key employees knowing it. If you end up running an auction process, or if there's a website that lists companies that are looking to be sold, word gets out quickly, and then you got to manage that.
Right.
And sometimes owners of businesses don't want that. So I think on the one hand, it's easier to find out companies for sale. It's very easy to get comparables of other similar businesses. What did they sell for? So you can get a feel for the current market for valuations. But I still think it boils down to relationships, and relationships are all about face time, spending time with people, building a relationship. And I think that while I think that's important, more people are moving away from that. So we'll see how that plays out. It's like kids at the dinner table playing with their phone, and you're like, hey, we're not having a conversation. Right. It's the same in relationships for doing deals.
Well, Andy, it's always nice to see you face to face. Thank you for joining us here on M&A TV.
Thank you, Claudia. Thank you very much.